In our previous video, we talked about why we need growth even after we've reached the stage of retirement. In this video, let's talk about ways that we can achieve growth. You know, there are so many investment options when it comes to growth potential. There are investment options that you would consider inside of the investment realm, and there are even growth options inside of the insurance realm put out by insurance companies. Let's talk a little bit about some of the differences and the trade-offs and the ways to manage the primary consideration in growth, and that's risk. If we look at this spectrum on the left-hand side, we have maximum growth with the least amount of protection, with the least amount of uncertainty. If you don't take any steps to mitigate risk, but just concentrate all your money in, let's say, a particular stock or a particular type of asset, you may achieve the maximum amount of growth, but you'll have a tremendous amount of uncertainty and the potential for significant loss. On the other hand, there are steps that you can take to achieve moderate rates of growth, not maximum rates of growth, but moderate rates of growth by implementing some risk controls. And some of the three most common risk controls are in the area of diversification, asset allocation, and even passing the risk of loss to an insurance company. Let's look at those. Diversification of asset types. That's the broad choice of asset allocation between stocks, bonds, different kinds of stocks, different kinds of bonds, different types of assets, even beyond those two categories, such as real estate or commodities or other alternative growth assets. If I divide my money up among different kinds of assets that don't all go in the exact same direction at the exact same time, I achieve higher levels of diversification. Secondly, dynamic allocation. Dynamic simply means it changes over time. So instead of statically dividing my money up among different assets that don't all work in the exact same way or move in the exact same direction at the same time, I can adjust the percentage that's in different kinds of assets over time, kind of like a dimmer switch, dimming or reducing exposure or increasing exposure over time. Now, if you think about the issue of increased diversification either statically on a one-time basis or dynamically, the reason that you're not getting maximum growth and instead you're over in the moderate growth is that diversification, whether static or dynamic, actually hurts you in a rising market. In a rising market, if you're dividing your assets a lot of different ways to spread out the risk, you actually have less potential for gains, depending on how the different assets that you're in increase over time. So diversification isn't needed if markets always go up. Diversification is only needed or useful when there's volatility and bad markets. Speaking of bad markets, the last way that you can mitigate risk is by actually allocating a portion of your money to what I would call protected growth. These are no-fee accounts that are created by insurance companies that actually protect the principal or protect their original money, but allow an investor to achieve moderate rates of return over the years in exchange for having a limited amount of liquidity or availability of the funds in the initial years. So once again, going back kind of to summarize, we're always going to need growth as a portion of our allocated dollars in investments. because of inflation. It's very difficult for our income sources to keep up with the growth of the expenses over the years. But we have many, many choices as it comes to how we want to participate in growth at a particular level of risk that we're comfortable with. Protection through diversification, through dynamically allocating, or even passing the risk of loss on to an insurance provider.